We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. And I am here today with Joe Viry. Did I get that right? Viry. Cool. Sorry, man.
That's okay. It's difficult.
Am known for asking somebody their name and then immediately forgetting exactly what they said. So, anyway, he's with U.S. Tax Advisors Group, and he is he's in sunny San Diego. So I know that makes me immediately jealous. But anyhow, it's sunny here, but I like San Diego because it's beautiful. But anyway, Joe, how are you today, sir?
I'm great. How are you, Casey?
Man, we're doing wonderful and just blessed to be here and glad to be hopefully talking to you about some capital raising, some syndication, and the tax benefits that comes along with all that stuff. Now, I want to kind of preface this discussion with a lot of times. So tax benefits for the listeners obviously is what everybody wants, but at the same time, it's somewhat difficult to make it entertaining or engaging. But I can assure you that Joe knows what he's talking about. He's been involved in real estate syndications. He knows the ins and outs of the tax law, and he's going to be able to help us with and hopefully answer some of your questions. And then at the end, if you didn't get your question answered, we're going to give him an opportunity to give his contact info. You can get in touch with him, get in touch with his company, and hopefully you can work out what you need to work out. So Joe, tell us a little bit about yourself and kind of walk us through maybe the beginning stages of how you got to where you are today.
Okay, very good. Thanks, Casey. I've been in entrepreneurial mode for all of my life after college. I owned a different type of business for 20 years. I was actually in a business that did special interest travel, special interest group travel, for radio stations and insurance companies. And then I sold the business in 2000, and I segued into financial planning and tax strategies, working with the California Association of Realtors. Yep. And in 2007, I had a guy that came up to me, a friend of mine, and said, I want to talk to you about this strategy. I think you might find it useful for your clients. So I blew him off. I thought he was trying to sell me soap or something. And about a year later, I finally said, Mike, okay, let's go for lunch and tell me what you want to tell me. He did. And I had clients that actually were looking at writing a check to the IRS for over $50,000. I put them into this strategy, and bottom line, I use the word strategy loosely, but bottom line is it saved them the $50,000. And if you all know what happened in 2008, the car went over the cliff and it went all the way to the bottom. And my experiences with the California Association of Realtors ended because their membership dove down to less than half. Yep. And nobody was selling or buying real estate. So, forget about tax strategies because everybody was just trying to survive. Yep. So the company that I used to put together this technique for some of my clients called me and said, why don't you come and work for us? You're really good at what you do, financial stuff, and you'd probably do very well. And I jumped into this industry. It's called cost segregation. And I'm not a fan of this name, but basically all we do is we resegregate the depreciable lives of the building components. What accountants will do, and what probably your dog can do, or maybe even if your dog's paw can use a calculator, it's very easy to a child. It's very easy to do straight line, because all you do is you take the building basis. Keep in mind that when you buy a building, part of it is land. Yep. We're not land appraisers, but somebody's got to take off the land part. So let's just use a simple uh, example. So let's say you buy a building, and I'm going to use a small residential building for 120,000. You tell me 20,000 is land, and now I have $100,000 to work with. If you do straight line depreciation, you divide the residential real estate by 27 and a half years.
Yep.
You're done. That's it. Simple, easy peasy. If it's a commercial building, it's 39 years. You're done. However, that's not the correct way to do it. And I think the simplest way to explain this is that everybody, if you're in either your office or you're at home and you look down at the floor and you say, okay, carpet is a 27 and a half year life asset. You would think I was crazy if you think that carpet's going to last 27 and a half years.
Yeah.
Because obviously, if you're lucky in a commercial setting or a residential investment setting, you're lucky if you get a couple years out of your carpet,
Yep.
5 years.
Yep.
So the IRS has come up with hundreds of different building components that they give a different life to. And the most common that we segregate out is 5 years for the personal property, which is in the inside of the building, things like countertops, cabinets, flooring, specialty lighting, window coverings. And then we have the outside of the building, which is 15-year land improvements, which is everything on the outside, curbing, sidewalks, lights, landscaping, cement, asphalt. That's 15-year property.
Now, are you dividing, if you buy an existing building, are you taking these cost components, or is this if you add new to that existing building?
Casey, that's a great question. We do a couple, we can do it a couple of different ones. One is different ways. One is we can go back 15 years from when you bought the building and still make it work by calculating the accelerated depreciation, deducting what you've already taken during those 15 years, and it's still probably going to come out to a very good value proposition. The other way we can do it is, let's say you bought a building and now this year you're going to spend X on the improvements. We can do this same technique for the improvements. So let's say you don't even own the building. Let's say you're a doctor, you go in or a restaurant and you don't own the building and you put in $1 million. I can segregate out all of the components of that building, the interior, the outside of the building, possibly too, but the interior of the building, and I can do it. I can do it just on the improvements alone. So it's varied. It's kind of morphed since I've been doing this, meaning that we used to originally just do the acquisition building, but now we're doing the improvements. And then also we are able to calculate the dispositions of the building if you bought a value add building. So let's say you bought a building and you, I just got on the phone, got off the phone a minute ago. This client bought a Walgreens in Southern Utah.
Okay.
They went in and after renting it to Walgreens for about 6 months, they decided it's not going to work as a Walgreens. We're going to make it into a pickleball court. So what they've done is they've ripped out the entire interior of the building. They're repurposing the building. They're making it into an indoor pickleball court. So now I have a 3-phase project. One is when they bought the building, I can accelerate that. 2, I can accelerate the $1 million they're going to put into making it a pickleball court after they're finished. So this will be in July. And then 3, I can calculate all the stuff that they threw away, all the building components, that has write-off value. The IRS does not want you to have 2 building components on the books. So if you go in under certain circumstances and you rip building parts out, throw them in the trash, the IRS says you must write that off. Well, if you're a client, a taxpayer, you want write-offs. Write-offs is good. Okay. That's really good. You want as many write-offs as you can.
Now, if you would, again, and I don't want to get too far in the weeds, which as my audience and listeners are very well aware of, I tend to do at times, but there's also, I'm familiar with the Section 179 where, and I think they're phasing that out. Is that correct?
That's correct. And now, we don't, I'm sorry, go ahead.
Well, I was just wondering, that's an accelerated, like take it all in 1 year write-off. What's the difference? Is a Section 179 for a new acquisition of something like a piece of equipment or
You hit the nail on the head. Mainly it's equipment. So we don't get involved in equipment or furniture or fixtures because you don't need me to. If you do need me, I can get involved. But most of the time, we deal mainly in the building components,
So
not
the
not in
cost
equipment.
segregation part of it. Okay.
Yeah,
Um,
but at the same time, the 179D is mostly equipment and it's very limited. So if somebody's going to tell me, hey, I'm going to do 179, I'll say do your 179, but there is going to be so much more you left on the table that you're still going to want to do cost segregation, bottom line. And so everybody just does cost seg in
okay.
addition to 179.
Now, is this cost segregation now real quick, and maybe you're not familiar, so I don't want to put you on the spot when I ask this, but I believe is agricultural buildings, are they isn't is there a different way you do those? Like for somebody buys a so and I figured out this a long time ago was these some of the land prices have gotten so high basically everywhere. And I'm talking about agricultural use assets or ground or farmland or whatever you want to call it. And you can part of the reason they got so have gotten so high is because people go in and they put a big basis on the buildings that are there, even though like they pay big money for a farm, they go in and put a big basis on the buildings, even if they're useful or not useful, depreciate them, and then that tax savings out of the basis on their ground, reducing the expense of the ground. So what I'm getting at is agricultural buildings and stuff treated differently than just like a commercial asset?
I've been doing this since again 2008ish, 7, 8, and I do not know of any special carve outs for agricultural as
Okay.
far as in my world. That being said, there are carve outs for different types of buildings. Like for example, a gas station,
Okay.
convenience store is a special carve out. That's 15-year property, and we can still accelerate it, but you've already got acceleration because instead of 39 years, you're down to 15.
Yep.
But I don't know of anything special for agriculture. However, I will say this, that there is not probably one type of building that I have not done, whether it be just a farm with fencing and sheds
Yeah.
and work sheds. I've still found value.
Yeah. Yeah. Well, that's interesting, and the cost segregation is it's so logical. Like everything about it is just straight logical, and it's just a matter of a lot of times people find keeping up with a laundry list of things becomes a little bit cumbersome. Is that right?
Yeah, it is a special niche part of the tax law. But when I first started, there was a lot. My most common objection was people say, "Oh, this is too good to be true. It's a scam."
Hmm.
I had to fight that and fight it and fight it and fight it for years and years and years. Nowadays, I will tell you, if your accountant does not recommend cost segregation or does not know what it
Find a
is,
new accountant.
I would say yes. You go wherever you need to go, but leave that guy. So in other words, now it's just generally accepted. It's not even an issue. Everybody knows this is the correct way to depreciate a building. Now, are there some cases where I would recommend not doing cost seg? There are some very, very few cases, but for the most part, I rarely find somebody that I recommend them not doing cost seg. I
Sure.
mean, obviously, if you don't have much value, oh, here's one. If you don't pay income tax, you don't need me.
Yeah, that's
Don't
right.
call me. You don't need me because
Yep.
I'm not going to take your money because you don't need me. But if you are paying tax, and let's face it, most people pay taxes. If you do pay tax, you will want my benefits.
Yep. You're exactly right. I mean,
Yep.
it's spot on. So tell us a little bit about what you got going on right now. And I'd like to kind of maybe shift the conversation towards real estate investing and syndications. And because now don't I want to talk a little bit about the K1 too, and how the expenses, because basically if you are an investor and you get a K1 from that syndication or that operating LLC, whatever it is, and they don't do the costs, don't isn't the cost segregation done prior to the K1 getting sent to the investor?
Yes.
Okay, so then it would be so if the operating company opts not to do cost segregation, then you get passed through just a traditional 127 and a half, or whether it be 139th or 127 and a half or whatever it is, year depreciation, right?
Yeah, and it's going to be high. You're not going to save money on your taxes. And so the question I would have to the syndicator is, why wouldn't you do it? Because yeah, you are passing it on to the onto the K1, but you're passing on to the K1 a reduced taxable income. Well, would you rather
Now,
pay
what
taxes
does
or
that
not?
look like when the building is sold? How is that recaptured by the IRS when the building is sold? If you write off the widgets that you put into it, and then you sell that for a gain, how is that reducing the
Well,
cost basis or no?
well, this is a pretty high level discussion, but I think everybody can grasp the concept here. What my savvy accountants tell their clients and how they work with depreciation recapture. And all depreciation recapture is, it's a tax by the IRS saying, okay, you've taken this wonderful expense throughout the ownership of your property. Well, now you got to pay a little bit of it back when you sell the property, and we're going to tax you on some of that accelerated depreciation you've taken, whether it's straight line or accelerated. But here's the difference. Because we're identifying the 5 and the 15-year property when we do cost segregation, what the savvy accountants will do is they will tell the IRS, it's like owning a laptop. You bought a laptop 5 years ago. It's now 5 years later, and you want to sell the laptop. You paid 2,000. What's that laptop worth? 50 bucks?
Yeah.
100 bucks? It's not worth much.
Yeah.
So bottom line is the accounts are making the same argument with the accelerated depreciation. So let's say that 5 years down the road, I have identified the 5-year property. Those accountants are telling the IRS, hey, there is not the same value as it was 5 years ago. Now, who determines that value? That's between the accountant and the client, but obviously it's not going to be worth much. So if I carve out $1 million in 5-year property, they'll probably say that it's worth $50,000 because it's been used up.
Yeah.
The same year for the same example for the 15-year property, a third of the 15-year property. So what does that mean for depreciation recapture? That comes off of the calculation. So you deduct the 5-year property that's used up, deduct 1/3 of the 15-year property. So what have you done? You've reduced your depreciation recapture. So it's a win-win situation. Not only do you get accelerated depreciation, but you get a decrease in your depreciation recapture. Now, I'll tell you, this is a pretty complicated and pretty highbrow strategy. So they would probably need to call me, or they need to talk to their accountant and go over this theory, because I will tell you, most accountants, unless they've talked to me or they have talked to somebody who knows about this, they don't apply it.
Yeah. Yeah. Well, because honestly, it's a pretty involved strategy, and the bottom line is that it's like anything else. Once you have to hire enough people or have enough hands on board, that it defeats the purpose of the cost savings, then you're going backwards. So
Right.
it's definitely one of those deals. But on the sale of the asset, that's where I really am getting a little bit hung up. Maybe it's just in my mind. But so when the asset is sold, so let's say you bought that $120,000 building, you took 20,000 off, you've got $100,000 left, and then you sell that building for 500.
Mhm.
All right, you've taken 20 of cost segregated depreciation. You sold it for 500. Are you paying taxes on 400, or are you paying taxes on 420?
400.
Okay, because you've reduced your basis to 100, and
Right.
then now you're paying capital gains on. I'm sorry, it was 380 or 400, not one.
Right.
But so you're paying taxes on the 400, and that's at the capital gain rate, right?
That's my thinking. Now, here's one thing I should definitely be very upfront, is that even though the name says U.S. Tax Advisors Group, we specialize in engineering practices to reduce and eliminate income taxes. So I'm not an accountant, so I'm not going to give you tax advice. And now you're getting into some pretty complex.
Yeah, I don't know.
I can
The
talk. Yeah.
scenarios. it's hard to kind of pull back out of that and get my mind back shifted to saying, okay, hey, how does this apply to real estate syndication? Because the thing is that a lot of and as marketers, okay, as marketers, we're always like I've always said, we find the line, right? And then we get as close to that line as we possibly can. And sometimes we reach our hand over there without stepping across, and we market, and it's marketed under the idea that these tax benefits are going to be wonderful. You need to invest in this because the tax benefits. Well, I had a problem with that as soon as I heard it, because again, as marketers, we're right on that line of saying, hey, these are wonderful tax benefits. They're wonderful immediate tax benefits. That's right. But there is still always the thought of a capital gain at the end.
Hi, this is Casey Brown, host of the Cashflow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cashflow Pro part of your day. Now, back to the show.
And that's where I think, again, there's a fine line between marketing and telling people what they want to hear and what they need to hear. And so that's why I'm trying to track down any just solid super tax benefits that investors can get and keep. But again, we always know that they can delay their tax liability by through a lot of different actions. And then of course there's always the ever so fun and popular 1031 exchange, which I wish I could get up every day and do 50 1031 exchanges. They're so much fun, identifying and moving and going, and you see the money fly. There's never going to be another bad day when somebody's got a $10 million 1031 exchange to do. So again, now you can whether you use cost seg or whether you use straight line, you can 1031 that the profit no matter what, right?
Well, there's a few wrinkles. What happened was when they did the Trump tax law a couple of years ago, they were rushing so fast and furiously to do it that they mucked that 1031 exchange up. Is it a reason not to do cost seg? No, but it does get a little bit different than it was prior to the tax law. And bottom line is the answer is yes, you're still going to want to do cost seg. But what happens is the amount of accelerated property that we find in a building, you're going to have to pay capital gains tax on that amount. So if I do find $20,000 and $100,000, you're going to have to pay capital gains on that $20,000. However, you've saved so much income tax over the years that capital gains hit versus the amount of taxes you've saved, it's not a reason not to do cost seg, but it does get a little bit different than it was before. I will tell you that. I wish Congress would fix it. We thought they were going to fix it, and they just are too busy. They're not going to fix it.
Yeah.
So that's it.
And that's so yeah. So you could, depending upon the long-term strategy, I guess the long-term strategy needs to be laid out in order to determine what's going to be best for everybody. And of course, what's going to be best for the majority, sometimes that leaves the minority screaming, but nevertheless, it's beneficial.
But here's the deal. I strongly am in favor with what you were talking about. I'll just, I'll complete the circle according to Joe, is you do need to spend a little time and money with a good tax professional.
Yep.
Somebody who knows this stuff, because I'm not giving you tax advice, but there are a lot of smart tax people out there that can answer the questions and can tell you whether or not the tax strategy is outlined by Joe or Casey or anybody else is the real deal, and it makes sense for that individual investor. So I don't go down that road, but I will tell you, man, I really love it when there's some brilliant people out there. And all I can tell you is that most of the time, the work that we do is, whether it's syndication deals or any type of real estate investing, I cannot even remember the last time anybody said no. It doesn't make sense.
That's right. Yeah. Especially it makes perfect sense. And again, like I said, as long as you're keeping the cost of doing the business lower than the savings that you're getting,
Right.
you're definitely moving in the right direction. And again, it's once you get all hands on board, you'll be in good shape. And of course, all of our PPM documents and everything. And I think a lot of people who do syndications basically say, hey, whatever our accounting practices are, this is what we do. Basically, if you like it, great. If you don't, well, we're still doing it this way. You know what I'm saying? So it's sometimes it's the non-popular way to go. But so what is tell us a little bit about, some of the syndication stuff that you've done. I mean, have you invested passively, or have you ever GP'd a deal
No,
that's
no, I'm stuck in my little tunnel.
Okay.
And that is the engineering studies we do. We do the cost segregation, which we spend a lot of time on. There is one little, I want to bring this up, is that we're one of the few companies in the US that will do those $120,000 buildings. We have developed another technique, because normally prior to developing this new technique, we had to inspect every building. So if you had a smaller building, I don't care if it's a farmhouse, a ranch, or an industrial building, if it was $500,000 or less, it didn't pay to fly somebody out there to measure and document the building. So we've developed another type of study, which we call modeling, where we can do everything online and through our pictometry software, which is satellite software. So that's, and the fees are very affordable. So that's one thing.
Acceptable
Oh yeah.
Obviously you're working against the potential audit, right? And if you have all of that in line and you hand that to them and say, hey, here it is, that's all widely accepted, I assume.
It is. It
Okay.
is.
Now,
I just thought I'd mention that. Yes, go ahead.
A quick question. And I know the way it is with mileage and vehicle expenses and depreciation, you do one or the other. And I'm assuming that this is much the same way, but once you start down the 27 and a half or 39 years, is it possible to switch how does that work or not?
Yeah, one of the misconceptions, there's so many out there, like they say, oh, it can only be done on new construction. No, it can only be done on commercial buildings. No, but bottom line is that if you bought a building, there's a couple little wrinkles involved here, but let's just say within the last 5 years, you bought a building and you did not accelerate the depreciation. You're just plugging along doing straight line. You can go back and you can do the accelerated depreciation, cost segregation, and your accountant then needs to fill out a form called a 3115, a change of accounting method form. And that form tells the IRS, okay, for 5 years or whatever it is, we've taken straight line and now we're doing accelerated. And here's the math to show you the accelerated depreciation after we've taken out the depreciation taken during that time. So
awesome.
Yes,
it's just a calculation that then turns and you cost segregate, but then you get the 5 years back on the cost segregation method.
Correct.
Man,
and so bottom line is we do that all day long. And the great thing about my company is we do those calculations. We can't sign a tax return, but we do all the heavy lifting. So all the accountant needs to do is check a few boxes. We give them samples of how to fill out the form. But bottom line is the hard part is those calculations. We do the calculations and give it to the accountant and they can file it. And so we can go back about 15 years. If you bought a building previous to 15 years, way far back, then it's probably not going to make sense. I mean, you got to pay me. You got to deduct the depreciation you took. So at the end of the day, usually if you're past 15 years, it's probably not going to work out. The other little wrinkle is that during because of the Trump tax law, They came up with 100% bonus depreciation. You might know that term.
Yeah.
Everybody talks the buzzword bonus, 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 100%, 100%. Okay. And it's really relatively simple. What the IRS said is if you bought a building September 27th or to current date, so any building bought previous to December 27th of 2017.
Okay, 17. Okay.
17, you can take bonus depreciation.
Okay.
If you bought it before that, you forget bonus. You're still going to get the depreciation, but you're not going to get the bonus. And all bonus means, it's really simple. It means that every the value of the building components that have a life of 20 years or less are subject to 100% bonus, meaning that you're going to write that off immediately. You're not going to, write it off over time. Previous to bonus, we wrote off all of the findings over time because you have a mathematical equation where you're combining 5-year, 15-year, and 27.5-year or 39-year. Just doing the math, it means that you have trails. You get most of it in the tax year you file the report, but then you get more the next year, a little bit more the next year, a little bit more the next year, a little bit more the next year. With the 100% bonus, you get it all in tax year. For example, if you're on extension right now, you would get it all for tax year 2021. So what does 100% bonus mean? 100% bonus means that after tax year 2022, the 100% bonus graduates down. I'm not sure exactly, but it's something like in 23, it's going to be 80%, 24, it's going to be 60% until it phases out after 5 years, and then it's back down to no bonus at all. Now, so is it the end of the world that you don't have a property that has 100% bonus? No. That means you're just going to get more benefit down the road. You're not going to get it all in the first year. But if you're a savvy investor, you want as much deductions as you can get in the current tax year, because it's the principle of the time value of money.
Yep, that's exactly right. Time value of money. If time value of money was taught more in school, like if you had to take one time value of money class every year you were in high school, I feel like a lot of money problems everywhere would be solved.
And one of the weaknesses of accountants, they can't spell time value of money. Yep. All they care about is filing a piece of paper to file to the IRS.
Yeah.
And they go, well, why would you want to accelerate your depreciation? Why not? Why would you? It's like, what do you mean? Why would I? Because I can save $100,000 in taxes.
Yeah, you save it today rather than splitting it up over the. You save it today. It's opportunity cost. I mean, there's all kinds of stuff that
you save the 100,000, and what are you going to do? You're going to go out and buy more real estate.
All right, so we're getting towards the end of our time. I'd like to ask a couple of questions. There's no right or wrong answers. This is purely for the listeners and something that they can connect with. But what is the best book that you've recently read or are currently reading? What's the best book?
I'm old school. I'm sorry. It's because of my long hair.
It's right. I got the same problem. So,
okay. I hate to say this, but man, this was my go-to book from when I was a little baby out of college. Think and Grow Rich.
Man.
I'm sorry.
Napoleon,
that book changed me.
Yep. I mean, it was just, I get, that's probably an answer I get second most to Rich Dad, Poor Dad. So, but it's a great book. I've got it. I've read it actually twice. So
I've read it
exactly what you mean. So
15 times. Yeah.
And then what's a dream vacation you've either taken or hope to take?
Oh, remember I was in the travel business.
Yeah.
So I've done some pretty wild stuff. I've been around the world many times, but the one that I hope to take, I don't know why, but I'm really intrigued. I've never been to Bali. I want to go to Bali.
I'll tell you, that is that whole, southern South Pacific, right?
Well, yeah. And I'll tell you right now, forget Bali, but my favorite tropical destination is Tahiti.
Wow. Yeah. That's that whole area down there is so intriguing. And, it really kind of almost starts at the southern part of the Philippines. I didn't realize how absolutely just stunning the southern Philippines are. Some of those little speck islands that you never hear of, never see, never talk about. But then you get into, oh man, yeah, I can guarantee you. So, all right. So listen here, how can the listeners reach out to you if there's something that resonated with them, or maybe they are currently having a tax, something or another that they need to speak with you about or email you about? What's a way for them to get in touch with you?
And here's the good thing is that for whatever reason, I'm not exactly sure why, but most of my clients are on extension. I have a lot of extenders, and I never ask, I don't know why, but they are. So if you're an extender and your accountant, you're looking at writing a bill for income taxes, I will tell you right now, get in touch with me. I don't know if I can help you, but the odds are pretty strong. If you own real estate and you've not done accelerated depreciation, I can probably put a dent in that. So the name of the company is U.S. Tax Advisors Group Incorporated, but it's really simple. Just USTAGI. So www.ustagi.com. Okay. And what we do is we do the first phase at no charge. The first phase is to give you an estimate and to look at the property and give you a fee. And then after that, if you say, hey, let's go forward, then of course we talk about, okay, you got to give us a retainer or pay us some sort of fee. But I would say that if you just want to find out more about, is this worth it or not, go to ustagi.com, and then you can put your property information online, and then we'll get back with an estimate, and then you can get on the phone and talk to me or one of my staff and decide if this is the best fit for you.
Awesome, man. Well, Joe, thank you so much. I know you said you were a busy afternoon and had a lot going on, but I do want to take a minute to say thank you for coming on the podcast and carving out the time to be with us today.
No, I thank you. Thank you.
Absolutely.
Good job, and I appreciate you asking. Thanks.
Yes, thank you so much.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.